Hello, everybody. Thank you. Thank you for coming. We have a tight timeline here, so we're just going to start. And I want to thank our amazing presenters, Joe Ogilvie and Natalie Leonard. My name is Matt Adams. I'm the coordinator of Passive Buildings Canada. We started in 2010 as a national nonprofit supporting passive house communities, sustainable buildings community, just to build a more sustainable Canada and planet. We do this through events, peer support, research, and more. Find us on passivebuildings.ca. Today we have two presenters, and we'll talk a little bit about the process, but we won't have a lot of time for a Q&A, but you should be able to see a Q&A option in your choices at the bottom of the screen. Otherwise, you can use the chat, and we will try to compile and edit questions to fit in as time permits. We're very happy at Passive Buildings Canada to be co-hosting with Passive House Canada, and I want to thank Passive House Canada and Michael specifically for suggesting a joint project with us. And I'm going to turn it over to Michael to introduce himself and to introduce our first speaker, Joe.
Thank you to Passive Buildings Canada. This is awesome that we've got this first webinar series, hopefully the first in a series. And thank you for everybody for making time. And as Matt said, thank you to our two speakers. I'm going to get right to it. Joe Ogilvie is the founding principal of Archangel Ventures. He's got a fantastic resume, and I think he's going to possibly touch on some of his accomplishments in his own presentation. So I won't repeat, Joe, what you're going to say in a moment, but uh, suffice it to say that you are very well equipped to talk about the financial case for passive house buildings for high performance. And we're grateful that you were able to make the time to manage the challenge a little bit, the time challenge. Joe has graciously offered to help respond to questions that are directly coming out of his presentation in writing. So please, if you've got questions, add them, write them up in the chat, and we'll be sure to engage Joe and to follow up directly. Some of it might be paraphrased if there's multiple questions on the same topic, but we appreciate Joe for being able to make that generous offers of his time. My name is Michael Quast. I'm the CEO for Passive House Canada. That's enough for me, and I'm going to, at that point, pass it over to you, Joe.
And thank you to Passive Buildings Canada and Passive House Canada for this wonderful initiative. I'm Joe Ogilvie, and happy to talk about the financial case for passive buildings with Natalie Leonard today. So I titled this presentation "Moving from Efficiency to Alpha." Alpha is a financial term that refers to that extra layer of value creation that investors often look for. And I think in today's context, this efficiency that we all sort of talk about is a real structural advantage in a world that is repricing energy and comfort. So as mentioned, I'm the founding principal of Archangel Ventures. I wear two hats. I'm also the chair of the OMERS and Oxford Leadership Institute in real estate and infrastructure at Schulich School of Business, which is at York University. I'm a director at the Toronto Region and Conservation Authority on that organization's board, and I advise the City of Toronto on its 2040 net zero strategy called Transform TO. I've worn a number of hats in corporate Canada, including the former National Director for High Performance Buildings at Turner Construction and Sustainable Construction Manager at PCL. So I have a little bit of hands-on experience that advises my real-world outlook. So I think I always like to start with where we are today in terms of the macroeconomic context. It's an interesting phenomenon that where we find ourselves is usually a function of where we have been. And when we sort of zoom out, we realize that we're at the tail end of what's a 70 to 90 year long-term debt cycle. When we come to the end of these long-term debt cycles, there's usually a lot of upheaval and change in the way capital acts, move, behaves. And so we're seeing this convergence with the end of the long-term debt cycle with some overlap in in productivity, the productivity of our overall economy here in Canada, as well as the intersection with the shorter term debt cycle, which is usually around 10 years. And so what we find ourselves, where we find ourselves today is at a point where there is tremendous amount of indebtedness, a lot of opportunity to improve productivity. So there is a debt productivity gap. And what this means is that we're also finding ourselves able to access less debt than at earlier points in the cycle. And so what this has material impacts for how projects unfold. Government's ability to spend and to incentivize projects is curtailed because debt burdens are at all-time highs and debt service is at an all-time high. There is an excess of private and institutional capital, but that capital is a lot more risk averse, and is very, very particular about how it allocates itself toward investments going forward. There are a lot of legacy business models around project and project delivery that no longer work because of this because of this new reality that we find ourselves in. And so what we see emerging is energy and comfort as real important levers that investments are critically concerned with. So the investment thesis that I want to offer today is that Passive House is actually a prudent investment strategy that provides some structural advantages related to superior asset performance. I think that the benefits accruing for a project from pursuing a passive strategy is not just the obvious lower operating expense and the higher NOI that it produces. I think we're all very, very aware of that. But more so the way that it aligns with policy and it reduces policy risk exposure, the way it accesses preferential and lower cost tranches of capital that could be coming from government-backed organizations like CMHC or like the Canada Growth Fund or like Build Canada Homes or any of the commercial banks that have lending products with lower interest rates that are attached to the lower overall risk exposure for high performance assets. I think it's also worth noting that these high performance assets are more appealing and have lower market risk from a demand standpoint. So I'll spend a little bit of time reminding us that that comfort is actually the root thesis of passive design and how it came to be. The market reflects all of these things in lower cap rates, capitalization ratios that look at the risk of cash flows coming from assets. So, we have more durable assets from a capital and from a financing standpoint, not just from an energy performance standpoint. So I think this is perhaps the perspective that most of us on this call would be familiar with. Energy being a core driver of net operating income, and that basic code compliant buildings or conventional buildings expose owners to severe shocks when you have a really harsh winter like we just did, or you have increasing occurrence and duration and severity of heat waves. Your buildings, they'll end up leaking money. And so passive design significantly reduces your exposure to some of those demand shocks and can materially improve not just the reliability, but the predictability of your operating expenses. I think what we're seeing is a change in some of the institutional underwriting standards to really take that more into account. It certainly has become a lot more accepted in Europe, where they have coordinated and centralized underwriting standards from the European Central Bank and other European lenders. That taxonomy has moved and is moving to Canada, although albeit a little bit more slowly. The US is still a laggard, but it's already happening. And all you have to do is look at the major institutional capital flows to realize that the underwriting standards have already shifted. The other important thing to consider is the alignment of policy in Canada from all three levels of government. So whether it's municipal, provincial, or federal governments.
So we're seeing that all three levels of government are seeing the world in the same way. There is coordinated action, and this is really producing a lot of what I would call accessible incentives to projects, from everything from sort of local standards and bylaws at the municipal leveling, at the municipal level, to different planning and permitting concessions, to at a provincial level, the way provincial building codes are advancing to reflect the importance of resiliency, durability, and efficiency, to at the federal level, where national targets and standards, financial incentives from federal government programs are all now coordinated. And I think this is a real window of opportunity that hasn't always existed. So I think it's useful to compare the capital stack. And what that means is the way different tranches of financing line up for projects. So on the left, what you see is a more traditional capital stack where there will be a developer that has some equity that it brings to the project, and then it secures some senior debt from a major lender, and there may be some investors' preferred equity, and possibly a tranche of mezzanine debt, which is kind of like bridge financing. This is I would say, a traditional, this reflects the traditional approach to how projects would have been financed in the past. Today, the capital stack is a lot more fragmented. So in addition to all of those tranches that were commonly seen in projects, today we also have tranches that come from impact investors, lower cost debt from government-backed lenders such as the Canada Infrastructure Bank or Canada Growth Fund. We see community bonds that are impact driven, and specific energy-related financing tools like PACE loans coming into the fray. And this is important in a capital constrained environment, which is why I set out the macroeconomic constraints at the beginning. So developers today need to cobble together a much more diverse array of capital sources. And in almost every one of these, there's going to be some requirement to demonstrate energy efficiency and superior resiliency in order to get that funding. So like I mentioned, I think it's important to come back to the origins of passive design. Passive design was always about enabling comfort as infrastructure for human performance. We live in a world where the whipsawing of climate is having untold economic and social implications. And it's easy to take it for granted because most of us live in conditioned environments, most of the time. But all you got to do is to have, a 24 to 48 hour disappearance of some of that conditioning for you to realize just how aggressively acute the risks from climate are. And so energy is the tool that enables us to achieve comfort, and comfort is that infrastructure that we need that backstops our health, our productivity, our prosperity, and a society that aims for high-performing economies, high-performing social climates, has to have built environments that are resilient both thermally and from a comfort level, if it is to underwrite economic resilience. Okay. So like I mentioned, we are seeing capital markets shift. The ESG risk is hardening, and it is being subsumed into underwriting practices. Institutional capital is prioritizing resilience. Portfolios are being reconstructed to reflect this, and to align with capital mandates. So this is all good news for scaling up passive design across all asset classes, be it housing, to commercial, institutional, industrial, and retail assets. The other thing that I particularly focus on is existing structures as a passive asset. So I look at reinforced concrete structures as an asset that is often underexploited. I don't just look at it from the perspective of converting, let's say, a parkade or an office building into housing, but I look at how can we add to it by using lightweight structural material like mass timber to fundamentally transform one asset using its existing structure as something that is part of the natural capital of the site. And so what this slide shows is basically how changing use actually changes the risk profile and creates a much greater value creation opportunity. So imagine a bill, and I'll walk you through a case study that we just completed. But imagine a 1950s, 1960s, 7-story bunker-like concrete building with low ceilings that is it for all intent and purpose a stranded asset being changed into a new high-performance rental housing product that is wrapped in a passive envelope, high-performance envelope to passive house standards. I think in this way, we are looking to align return expectations, social impact, and environmental performance. The key stakeholders and their priorities are obviously private institutional investors that still need a financial return, impact investors and community housing providers that want to see durable, reliable, resilient, and affordable housing, public agencies that want to see not just affordable housing, but also want to see revitalized urban environments. They don't just want to see older, decrepit buildings that continue to be laggards and don't generate sufficient municipal property taxes. And community housing providers who have a housing first lens. So what that means is the delivery of social services and benefits are anchored in security of tenure and housing. So this is a case study. This is a building that is located at 931 Yonge Street. It is the headquarters building for Toronto Community Housing. It's transit oriented, so it sits just south of Rosedale subway station in Toronto. And the city wanted to see, they put out a request for proposals. They did an indicative design where this building, 7 stories, would be demolished. It would be its foundations would be uprooted. And then there would be further excavation on the site to build even deeper foundations to support a 32-story concrete frame tower. So instead of this, we looked at the concrete structure as a passive asset that was part of the site. And we came up with an alternative proposal to add 18 stories in mass timber. And basically we use the existing foundations and structure with some modifications to stiffen and strengthen. We also approached this through a 99-year ground lease in partnership with a local community housing provider called Wood Green Community Services, where they would actually be a joint equity owner in this asset. And what this allowed us to do was to turn this 50-year-old 7-story concrete building that's near its end of life into an effectively brand new 231 unit purpose-built rental building with 36% of units being affordable. So I think I covered all of this just now. Next slide, please. So this basically shows the approach to reworking the existing floor plates to squeeze 9 units per floor out of the existing building. The next slide will show the treatment of the overbuild, a standardized repeating floor that achieves 10 units per floor to get us to that total of 231 units. There is the repeatable mass timber floor of our overbuild product. We branded it Haven because we like to think of it as not just shelter, but also a place of safety, security, and belonging. And so it is, again, 18 stories of timber added on top of the 7 stories of reinforced concrete with selective strengthening throughout the existing structure and that foundations to create an entirely new asset from this building. I should point out the core of the building runs from the foundations from below grade all the way up through the 25th floor. So there's a contiguous new concrete core that is punched, and that provides the lateral bracing required to sustain the durability of that building. The picture at the top right shows some of the renderings of the interior units. So these are what we have a mix of units, studios, ones, twos, 3 bedrooms, including some 2-story units that are larger family style units housed in the existing building. There are amenities in the building that would be commensurate with a market product offering in this neighborhood. So there's gyms and bike lockers and lounge space and co-working space, all of the things. So in other words, we're not compromising on the market offering. We're able to accommodate and compete with brand new ground up developments using this redevelopment typology. We have some unique construction logistics approaches that really synergize well with building for passive design, where there is very, very high levels of airtightness. There's a company called Umbrella that provides a sheltered construction workface solution that would be used to both protect the timber and to ensure that all of the envelope critical work happens in a sheltered and controlled environment. So I just wanted to point that out. And to get to the economics of it, this is a project that would cost about 839 million, depending on what financing program we would use. And because it is an adaptive use project that has very high performance systems, not least of which would be a very energy efficient combination of, R30 envelope, effective R24 with air source heat pumps delivered through an active hydronic unitized system. So the distribution in units are unitized. They're connected by hydronic lines, and each unit in the suites have 90% efficient ERVs. We are able to reduce the OPEX ratio for this building to below 30%. Buildings of this sort are typically around 35% OPEX ratio. We are able to achieve below 30%, so somewhere around 27, 28% OPEX ratio, which means that our NOIs are a lot more durable. And again, the benefit here is that this allows us to access about $30 million in concessions from the city, both in terms of development charge reductions, because we are achieving a high level of environmental performance per Toronto Green Standard that qualifies us for DC waivers. We're also able to access much lower cost financing through CMHC's ACLP or MLI Select programs, which give you higher loan to cost ratios for energy efficiency. So you can see it cost 138 million to build, and the exit valuation is about 158 million. And that is a function of the lower financing burden and the more durable NOI. There's also a slight valuation premium because of the lower risk of the cash flows that come from this asset, owing to we didn't really even underwrite any revenue premiums. We just said, owing to the durability and the constant demand, which is mostly, to be honest, a function of the location and the OPEX ratio, there is that slight valuation premium that we have underwritten. And we've seen evidence of this in other transactions for high performance buildings. So knowing that institutional investors would target a 16 to 17% levered IRR, we looked at the amount of concession or incentives that this project would qualify for, that would be part of the capital stack. And we exceeded the project was able to secure more incentives than were available, which means that we would meet or exceed this 16% levered IRR hurdle. And from an equity multiple standpoint, depending on the CMHC financing program, we would be able to meet or exceed investor requirements for which is usually around 1.8 times the equity injected. So with the ACLP program, we would be able to achieve 2.05%, which is a really attractive return in this environment. So the key takeaways here are that, and this is probably not going to be news to many of us on the call. High performance buildings are financially feasible with the right financing structure and policy support. Those preconditions exist now. The key is to be able to design a cohesive product collaboratively that is able to access high leverage and to maximize the impact of government concessions. It's still the fundamentals of real estate still apply. So location still matters. Your unit mix and tenant mix still matter a lot. So you have to be able to make an attractive product, not just one that is energy efficient or durable. And that's my presentation for today. So thank you for allowing me to share this with you.
Joe, really appreciate it. I know you have to run, and as I understand it, you're kindly going to accept questions virtually, and we'll post his email. Joe's off and running, so we'll post it. I think in the chat. We're gonna go on to our second presentation from Natalie Leonard. A number of years ago, I started to hear the name Natalie Leonard come up an awful lot in the green building world, and just because of all the exciting stuff that they were doing. Word was she was building passive house buildings in Nova Scotia about the price of code, and going around and putting them up where other people hadn't even heard of passive house. Natalie was the first certified passive house consultant and certified passive house builder in Canada. I've heard Natalie speak and present a number of times, and it's always illuminating. Her company, Passive Design Solutions, has done a wide range of things, but is really beginning to move more into the affordable housing space. And I'll let Natalie explain all that. And then Natalie will be here for questions at the end. Natalie, take it away.
Thanks, Matt. And thanks for the invitation today. And I certainly learned a lot about the inner workings of getting finance for large projects. My company we're pretty small. We're based in Halifax. There's 10 of us now. And we started working exclusively on passive house and net zero buildings in 2009. So been at it from, I remember the first time I did a search for passive house Canada on the internet, and I got 5 returns. The last time I did that, it was like 5 million or 6 million. So a lot has changed in the last 17 years since I started this work. So we started off as a design build firm. I come from a construction background. I'm an engineer. Which was an interesting way to start, because we tested everything we designed and eventually realized that we could do more good by spending more time on design and less on drywall and flooring, in order to leverage our knowledge base to do more good work in this area. We've worked on 400 plus, have lost track of passive house net zero projects to date. And we certified 14 projects with FIA's certification in the past. So our specialty is wood frame residential construction. We do a lot. We in the past, we worked exclusively on single family. In the last 6 years, we've moved into multifamily custom work. We work a lot with affordable housing associations, and as we go through, you'll see why. And we've also developed a series of stock plans, passive house stock plans for single family and multifamily, because we're trying to remove some of the time and the cost of the project startups. So my take on the financial side is that it depends, and that the answer is complicated. So let's dive into that a little bit. The first thing I want to talk about is a little bit about design, because one of the things we see in the market is these comparisons. If you take this building and you upgrade it to passive house, it costs 15% more, 45% more. And the bottom line is the design and the complexity of the design typically can cost more than the energy upgrades. And when Matt's talking about us building at the same price as code, the design part of it's been a big part of that. So we do a passive design review scorecard where we have a number of parameters where we measure the efficiency of the design. And in energy modeling, a ton of projects, many we've designed, but many that others have designed, we've seen that this is just a rough saying, but about 50% of the efficiencies are achieved by smart design, and 50% are achieved by what we put in the building. How thick are the walls? What are the mechanical systems? So you can see things like building shape, building layout, window and door design. This building that these three images you've just seen are the only images here that are not our photos. But you can see that this building is going to use a lot of energy in heat and cooling due to the losses and gains through glazing, and it's probably expensive to build. So those types of efficiency and design are critical in achieving financial viability. So just for give you a couple of examples, this is the first multifamily project we worked on. It's 25 units of housing for women and children at risk. And working with the structural engineer to do value-driven engineering, we were able to reduce the concrete for the walls by 25%. We eliminated interior bearing, which was better for energy and better for cost. And the simplified roof design is, again, cheaper to build, but also provided the space for solar. This is a net zero project. For me, it really breaks down to who we're talking to, who cares about what. And homeowners, one of the things that we see is they want to do right by the planet, and they want energy security. When we look at private developers, we're talking about capital costs and those return on investments or return on operating investment, as Joe was speaking at. They also care about vacancy, and that can be a factor where they want to do better because it's going to attract tenants. In the last 5 years since COVID, you could really rent anything, your renovated garage with no bathroom, in some cases to students here in Nova Scotia. But in the real market, there is competition between rental units, and private developers do care about being able to sell their units compared to the neighbor. So affordable housing, we find that capital costs are easier to come by than operational costs. They really struggle with operational funding. So they have a bigger focus on durability and the life cycle costs of the building, including the operational costs. And many of them also align with environmental values of sustainability and doing their part for the planet. So let's look a little bit into homeowners. For us, we have only worked on custom built homes. We have not made any grounds into tract builders, where the homeowner's buying the house that's already built. We've had really good rebates from Efficiency Nova Scotia over the years here, and those rebates have certainly done their job in driving owner interest in passive house and net zero. And they'll often make value-based decisions. One of the things we say is what is the ROI of a granite countertop? So it's about the values that the homeowner brings to the project. Often financing is less limited. Many people that can afford to build a custom home are not dependent on borrowing the maximum amount at the bank. So that part of it's easier. And The financial model depends heavily on the interest costs, if any. So if or looking of what that capital could have done for you if it wasn't invested in your home. So typically, just as a note, single family buildings, because they have a greater surface area ratio, tend to need more building envelope upgrades, and mechanical systems have less of an impact. And for us in the experience, and this has been really consistent, is most owners will ask up front how much it costs, and we'll give them a number, and anywhere from 0 to 15%, depending on rebates and market conditions. And then they never ask again. So it's not like they're actually looking for the numbers. They just want some assurance that it makes sense. But really what's driving them is more their environmental values and often wanting to feel like they're doing the right thing. The for-profit developers, that they have a number of decision factors, and I think Joe explained these much better than I have in this slide. But those cap rates, that how much they have to invest and how much of a return they're getting on that, it's very dependent on interest rates when you do the math to see what kind of upgrades can be afforded based on what the interest rates are. That what's driving a lot of it is as Joe alluded, the energy requirements from funders. Often there's more points for higher tiers, and these owners definitely want to see a business case for passive house or net zero, and they want to see the hard numbers. For most for-profit developers, they don't care about the power bills. They're not paying them. The tenants pay them. And that's why we see a lot of buildings that have ductless mini splits on every balcony, and electric hot water heater in the closet, because the owner greatly reduces their risk by not paying for power. As I mentioned, they do care about vacancies, and a lot of what's driving the move towards doing better in the energy efficiency world is being driven both by funding requirements, and also the upgrade in the tiers of the energy codes. And rebates can certainly help make the case. We had a for-profit developer that did a near passive house upgrade. It's not a certified building, a fairly large building, 50 or so apartments, and they had a 1.5-year return on their investment based on the rebate that they got from Efficiency Nova Scotia at the time. The rebate paid for 80% of all of the upgrades. So we've had a fairly difficult time making a financial case for passive house with private developers where they do not pay for power. Not-for-profit affordable housing organizations, funding is a huge component, and as Joe talked about, they're definitely layering up their funding from a variety of sources. Many of them are grants or low interest rates loans. And there's definitely points in the applications for net zero ready or net zero. Some of them have just a minimum energy intensity target requirement. Some we're seeing they're requiring a higher level of tier in the energy codes. And the funding also has requirements around affordability, which includes energy costs. So, and one of the big challenges we see is what's deemed as affordable by the federal programs and by the provincial programs is actually quite different. So they have to do those pro formas twice in different ways, using different rent maximums. But that rent, whatever it is, whether they charge the power bill or not, has to include the total cost of the rental. Rebates can tip the scale. A number of our projects we're working on right now have a $400,000 rebate from Efficiency Nova Scotia for affordable housing, net zero ready, passive design buildings, high performance buildings. There is, as I mentioned, a greater importance to the operational factors. Having the tenants pay for power. One of the challenges with deeply affordable projects is some tenants can't get a utility account. The energy use varies greatly between renters and owners. So the homeowners are all kind of energy geeks that want to do really well with their power bills. It's harder to motivate tenants to care about the power bills, especially if they're not paying for them. The demand charges remain with net zero buildings, and as we moved into multifamily buildings and targeting net zero, we realized that we can get net zero site energy, but that doesn't mean they don't have any bills from Nova Scotia Power. The mechanical and electrical equipment life cycle costs matter. If you put 50 heat pumps on a building and they all have to be replaced in 7 years, that's going to be a difficult expenditure for a not-for-profit organization. Especially our not-for-profit organizations are relatively small compared to the size of the organizations you'd see in Ontario and Toronto. And as I mentioned, the capital funding has certainly been easier to secure for housing than their operational funding. Next slide, please. So we use a simple tool that we can fill in the interest rate and the mortgage term and the expected escalation price of energy. And one of the things that it highlights is that the permanent upgrades like insulation, airtight, and windows actually justify a larger initial investment because they don't have the same replacement cost life cycle. It may be safe to say that the insulation is in there for the life of the building. Windows will certainly last longer than ductless mini split. Then we do a separate calculation on the multiplier that's related to mechanical upgrades. The lifespan is at 12 years, which might be in this particular case, which may actually be generous. A lot of mechanicals are 7 to 5 year replacement. So the justified mechanical upgrade is significantly smaller than what we call the permanent upgrades, the building envelope upgrades, which really enforces the concept of passive house approach first and upgrading your mechanical optimizing your building envelope and then sizing your mechanicals to fit that envelope. So in addition to the lower power bills, these high performance buildings, they have lower demand on the power grid, which gives lower demand charges on larger buildings, and also helps in society because we are, as we're adding electric cars, and other loads on the grid, not to mention AI data processing, we're using more and more power, and those demand charges in Nova Scotia, for instance, those peak demands are met with 9 coal-fired power plants, and they cost a lot of money to keep open just to use for those peak power times. We have simpler and smaller mechanical systems which cost less to install, but also have a lower operational cost and life cycle cost. In the bigger buildings, we need backup generator systems. These run self-test, which means they're burning fuel regularly to keep them operational. So they have an environmental impact and an energy cost. But we also get a lower capital cost and also that lower operational cost with smaller backup systems. And then back to that design factor, that compact building shapes that are not overglazed use less energy and are less expensive to build. So when we're working on a lot of our, almost all of our affordable housing projects are targeting net zero in order to really help control their risk on their operating costs. And so what we're doing a calculation on, this is 4 buildings that was 4 buildings that composed a affordable housing project in Halifax. So we looked at that comparison of how much do we have to spend on an upgrade, and then how much does that save us on the solar system. So as long as the blue bar is above the green bar, we know it's a viable upgrade to make from the cost perspective. And we also consider the space for the solar system. Mostly in multifamily, you're looking to fit that system on the roof, and we don't work on a lot of high-rise buildings, so we generally can get enough roof space. And also considering ground mount solar as well. So, but the risk is energy modeling is based on assumptions about occupant behavior. And this is this same project. One of the buildings has unit by unit monitoring on it. And there's a lot of information on here, but just to kind of give you the Coles notes, there's 1 bedroom, 3 bedroom, and 4 bedroom units. And the worst variance is in the 3 bedrooms where there's more units. This is only a 12 unit building. The tenant that used the most amount of power used 3.4 times more power than the tenant that used the least amount of power. So achieving net zero can be a challenge, because we see about 60% of the, once you take care of the heating, cooling, and hot water and ventilation efficiencies, about 60% of the energy use in these buildings is driven by occupants. And the variance we see in how the occupants use energy, as I say, up to 341% more in this small project. So then those high uses are also driving demand charges as well. So we are seeing significant operational costs that the affordable housing organizations just don't have in their pro formas. The rents in this building would range from $400 a month for a 1 bedroom up to $900 a month for a 3 bedroom. So well below market in the Halifax area. And delving into this, there's a good bit of research out of Edmonton, and the key results we see is that tenants that don't pay for power, don't pay for their energy, use 70% more of it, and developers that don't pay for power build buildings to code. They're not motivated to upgrade because they're not saving on their operational costs. And this research is recommending the solution is shared accountability, where there is some accountability to the tenant and some to the building owner to do better on our energy use overall. So this is something we're trying. We're just implementing it now. We're on a number of 3 projects are implementing it now. So we'll see how it goes. We're using a third-party billing company where the tenants pay for the power they use to the third party. The owner pays Nova Scotia Power for the net bill, which includes the solar credits, but also the demand and load charges, which have been significant. And then there's a net income at the end of the year, because the buildings are modeled to net zero targets. And so what we've done is, and at this point in time, we haven't decided exactly how that will be divided up, but the net income. So after Nova Scotia Power is all paid and they collect for all the energy use, there will be money left at the end of the year, and it will be divided up in a way to reward those occupants that are using less energy. And we've created 5 different models. We're not sure exactly which one we're going to use until we can see some actual data of what those variances are. But there will be an incentive for the tenants to use less power. And that creates the shared responsibility. And it's really eliminating the risk to the not-for-profit owners that don't have another pot to go for those operational costs. And if we can reduce energy use by 70% overall, then that's also very good for the planet. So kind of in summary, the key elements from my perspective in making passive buildings and net zero buildings financially viable is energy must be prioritized as a project goal to start off with. that wherever that project will be funded, that the funders are looking for and reward higher performance buildings, that we can optimize the building design to consider energy efficiency as one of the key design priorities. And then we're going to use cost-effective passive house strategies before implementing renewables or sizing mechanicals. And then we're designing also to reduce the peak loads on the grid, especially for the non-residential utility rate codes. Doesn't mean it's not housing. It means it's multifamily housing is subjected to demand charges. And and also finding ways to have shared responsibility between the tenants and the owners for energy use and costs. And what we see is every project is different, and use an energy model to assess the return on investment of your design decisions, and get a team working together in order to prioritize the project goal of high performance. That's the end for me, and I'm happy to take any questions that are out there.
Thank you, Natalie. That was great. I know I've got some, but I'm going to stand on my hands for a moment. So we had a couple come in the chat. I'll start with the more general one. Can you talk about the rental multi-unit investment and financial based on government support? You touched on that a bit, but
yeah, and it's ever changing, as we all know. A number of a couple of the projects that we're building right now, they got a significant grant from the co-housing fund federally. They got there is a fairly substantial grant that'll come from the provincial government for affordable housing, as long as you're meeting energy targets and also affordability targets, and points again for accessibility. Those are usually the three main factors that are contributing to the score. Then they both had land donated by the municipality. One had municipality donate $200,000 upfront towards soft costs. And then the rest of it is financed through various loan programs, some at the bank, some through the CMHC program. I'm not sure where everything is going to land with Build Canada when the CMHC programs all end and end up over in Build Canada. I've heard talk that they don't care about energy anymore, but in some of the applications we've seen, that has not been the case. There is points for high performance building, and yeah, so it's going to be interesting to see. And I've also heard that they want really large projects, and we have a housing crisis across Nova Scotia, equally in small towns as in the municipality of Halifax. So yeah, we're yet to see how they're going to come together in the future, but they've certainly been stacking their financing, and they've been able to secure both of those projects have about 75% of their construction costs as grants, forgivable loans, and they're only financing about 35% of the actual construction costs, which is what's allowing them to keep their costs down and make investments to keep their operational costs down in the future.
Thanks, Ned. We had another one asking for funders requiring, outside of those grants, maybe single family home and MERB, and we just looking for examples you had experience for getting rewarded for high performance buildings. I mean, you mentioned, of course, CMHC. We don't know what's happening with the new projects, but are there other any financial institutions give you all any extra anything, or has that not been your?
Yeah, like right now there's no, we don't get anything municipal. Some of the affordable housing projects will get a break on, they'll get a break on their building permits and their taxes, but it's not really for high performance. It's based on affordability, but the high performance is a critical component of achieving the affordability. So it's kind of indirectly tied. I know some other municipalities have very specific programs that'll reduce borrowing costs or provide more support to projects, but we don't have that happening in the Maritimes.
Do you have time for a couple more, Natalie?
Yeah, I'm good.
One was just, I think, mostly about passive design solution, your company. The question was, are the stock plans compatible with modular construction, and how would affordable housing providers go about an agreement to be able to use such designs?
Yeah, so I didn't touch on it in the presentation, but we've done quite a lot of work on modular. There's a high performance new modular builder and manufacturer in Nova Scotia that we've done, I don't know, maybe 6 or 7 projects with that have been volumetric modular, and probably another 12 projects that have been panelized passive house level walls. And I think that it's interesting. One of our team members is making a presentation today that's just on volumetric modular and the pros and cons. We have not seen there's been a cost advantage yet. There's still a lot of learning, and there's a lot of kind of duplication in some of the structures and just the limitations of having to make multifamily connections on site, fire, services, etc. So, but we think that there's a really bright future for volumetric modular, and the projects that we're doing. I think there's a 50 unit, a 22 unit, another 20 something, and 2 8 units. The 2 8 units are finished, and the other 3 are under construction. So we're gaining a lot of learning in those projects. And they were for the Nova Scotia Public Housing Authority. If anybody's interested in kind of searching around for some information.
That's great. Let's do, Chantel, I see your hands raised. If you have a quick, short question, you can just unmute or type it in chat.
Sure, yeah. I just wanted to mention that if you're or anyone online is doing a project in New Brunswick, the new construction program at Save Energy NB has some incentives, and more recently, some larger incentives for nonprofits and privately held affordable housing. So for example, for an NECB building, it's up to $150 per square meter for reaching tier 3. So we're hoping to see some passive house quality projects coming through.
Great, thank you for that.
Natalie, that was outstanding. Some great content. I was glued to the edge of my chair. I'm really grateful for your insights and your experience. And I hope that others got the same wealth of information. To your point, Matt, really quickly, Passive House Canada, we're celebrating our 10th anniversary this year. We've been around for 10 years. We are a not-for-profit. We're a national. Our focus is advocating and educating towards the Passive House standard. My personal view is that we need more people in the tent. Your North Star may not be Passive House per se, but if you're about building performance and trying to achieve a higher level of building performance, then you are an ally and a friend, and we are grateful to have you in the community. We have a conference coming up. I'm going to a shameless plug here, Matt, if you don't mind. We've got a conference at the end of May in Vancouver, British Columbia. It's an annual conference. We've got some great presentations over 2.5 days, some tours planned. If you haven't checked us out, please do. PassiveHouseCanada.com and navigate your way towards our conference. And that's it. And I'm delighted to see so many people engaged right through to the very end, Matt. I think that this was a good first venture between Passive Buildings Canada and Passive House Canada.
Thank you. And thank you, everybody. We're planning tentatively to do a couple more on this theme of ROI. And we haven't worked out dates or things like that, but we'll certainly be in touch. My last minute shameless plug is we have an event on May 12th in Creemore. You'll find that on our website. Thank you, Natalie. Thank you, Joe. Thank you, everybody. Until next time.